You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again for TWIFO, This Week in Futures Options, the program where the name pretty much says it all. We break down the week that was and indeed still is on the futures options side of the fence. You never know what's going to make it onto the show. Is it going to be ags, metals, FX, equities? You never know. Got to tune in every week to find out. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we tend to think so, Options Insider Radio Network. Reminding you, of course, if you like what you hear here on the on-demand front, keep rating and reviewing. It really does help all those new folks continue to discover the content, and they are legion. There are so many new people discovering the markets these days, so help them discover this content. theoptionsinsider.com/pro, of course, where you can go if you want to get more in your ears beyond just the shows we're doing on the on-demand front. You want to get exclusive content, a couple exclusive shows coming at you every week. We have a double dose of them coming at you again tomorrow, as well as, of course, giveaways. We have indeed the June, it's hard to believe, July. Hard to believe we're already at the July Pro Trading Crate, but that is where we are these days, listeners. And of course, if you want access to this show and everything else we do live throughout the week, theoptionsinsider.com/pro is the place to go. And let's see who's joining us on the old TWIFO program today. I am pleased to welcome back to the CME Group and FTSE Russell hot seat. He's now a frequent offender here on the program, Mr. Rich Excell. He is the clinical assistant professor of finance over there at U of I. He's also the co-director of the Investment Management Academy at U of I. So a lot going on over there. Of course, the last time he was on, he brought some fun Time Butterflies, which is a unique addition to the offerings here on the show. So let's see what he's come armed with today. Rich, welcome back to the TWIFO program.
Mark, I'm glad to be back, glad to be a frequent offender. It's nice to be in that select company.
Yes, a very select group as we keep on rolling right on into the Movers and Shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everybody, welcome to the Movers and Shakers. This is indeed the portion of the program where we break down everything, lighting it up to the light side and, of course, to the dark side over there at CME Group this week. If you guys want to see this report for yourselves, this is one of the few premium offerings you guys get to access for free because we like you folks. CME Group always tweets out this chart right before showtime. We do as well. So if you follow us at Options, you follow CME on Twitter, you should have access to this chart. And if you looked at it this week, this is a rarity. I'm trying to think of another week where we've had a chart like this, listeners, where really we are struggling to put together a dark side. Looks like we can do 2, 4. We could do 5 barely. And that's really about it. So we could do a bottom 5, but literally everything else on the chart is green, listeners. I can't recall another week that was as heavily biased in one direction. Maybe outside of, let's say, the big sell-off in March of 2020, outside of a week like that. Very hard-pressed to think of another week that is so directionally biased. That said, Mr. Rich, you are our guest, so you get the pride of place. You get to choose where we start this week. Should it be to the light side or to the very anemic dark side, sir?
Well, why don't we just start with the dark side and get it over with? Because it's not, like you said, there's not too much on there.
Yeah, not too much lighting up the tape out there on the dark side, listeners. So to the dark side we shall go. Of course, you guys know where to go to generate all these reports, including the premium stuff. If you're listening to this show and you want to get access to all that premium content, premium analytics, Bantix, BANTIX.com is the place to go. Trust me, if you're into these products and into these markets, then you definitely want to check those out. Let's see, number 5. This is how anemic things are, listeners. Number 5, the bottom of our dark side this week, is Class 3 milk, off a whopping 0.09%. I can't remember we had anything in our top or bottom 5 that moved so little. But again, that is a week we have, listeners. And Class 3 milk's actually putting up some numbers this week, so we could maybe hang out there. 9,000 contracts on the tape. I mean, Class 3 milk, when we first started doing this show, or even its previous incarnation, the long and short of futures options, dairy as a whole would do a few thousand contracts in the entire complex. And now we're seeing 9,000 contracts going up in Class 3 milk. So that's nothing to sneeze at. Number 4 is the NASDAQ 100, off a whopping 0.15%. It was number 5 in the other direction last week, listeners, up 5.85%. Number 3, Euro USD. We're just talking about, that breaking that parity with the euro on the show last week. Euro USD still hanging out at number 3, a whopping 0.29% to the dark side. Oats, number 2, getting a little bit of action now, off 4.22%. Before you get too excited, Oats, as you know, listeners, not a big option stalwart, so not a lot to parse there. I'm guessing they've done 3 contracts this week, maybe. And then number 1 is one of our 3 frequent offenders. You know those frequent offenders are Bitcoin, they are nat gas, and they are lumber. You can guess them in any week, and chances are you'll find at least one of them here. This week it is lumber at number 1 to the dark side, off 10.35%. It was number 5 in the same direction last week, off 5.78%. So a rough couple of weeks for lumber. Now to the light side we go, and here, listeners, my goodness, we could do a lot of light side living here this week. We'll just keep it to a top 5 for now. Number 5, this shows you how aggressive the light side is this week, listeners. Number 5 is soybean oil, and it's up 7.78%. That's usually good enough probably for number 1 in any other week that isn't a crazy week like this. By the way, if you're wondering how much paper goes up, soybeans do a lot of paper. What about the rest of the soybean complex, if you will? Soybean oil, 51,000 contracts. Nothing to sneeze at out there. Number 4, one of our other frequent offenders, nat gas, back on the board again this week, up 7.9%. It was number 1 to the light side last week, up 22.2%. So quite the run for nat gas over the last couple of weeks. Number 3, still hanging out in energy. It is RBOB, up 8.5%. Again, before you get excited, a whopping 746 contracts on the tape this week, so nothing really to sink our teeth into out there. Number 2, back to the soybean complex. It is the beans themselves, up 12.53%. It was number 4 to the dark side last week, off 11.48%. So soybeans are given and taken away every week. This week, they are given back. And you know soybeans do some paper, 266,000 contracts on the tape in soybeans. So we could certainly hang out there. And number 1, a kind of lesser heralded aspect of the soybean complex, the soybean meal, easy for me to say, soybean meal, up 13.33%. It was number 3 in the other direction last week, off 12.41%. And this one also does some paper, 75,000 contracts. So you're adding up all these different constituent parts of the beans, and you're closing in on 400,000 contracts. So nothing to sneeze at out there in the beans land. So a lot to unpack across a wide variety of complexes. But Rich, I know you've been busy since the last time you and I chatted with a lot of research, including some interesting stuff in energy. So I think we'll start in there first.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the world of energy. Before you get into your current research, I know, Rich, the last time you were on, you shared with us some interesting time butterflies in the ags. I know a lot of our listeners were intrigued. We got a lot of interesting feedback on that. Did you get some interesting follow-ups from our listeners about people requesting your charts, Rich?
I did. I appreciate that. I definitely got some. That one was definitely a little bit out there. But, what we talked about last time too, Mark, is we just take what the market gives us, right? And so you look at the setup and you just got to ask yourself, okay, what's being priced in and what do I think about what's being priced in? And so therefore, what's the trade? And so that one kind of fell out that time. And, this time when we look at energy and oil, maybe it's a little more straightforward and standard. But again, we always just try to take what the market gives us.
All right, listeners, of course, if you guys want to play along in oil for yourselves, pop into cmegroup.com/TWIFO. You're going to get that nice asset class drop down. Then we're going to go down 3 in the asset class to energy. We can start over there in the land of crude oil, because I know Rich has been watching that a lot. Unfortunately, RBOB, like we said, not a lot of paper. And then, of course, nat gas will sink our teeth out there as well. But, Rich, you've been doing a lot of research leading up to the OPEC meeting next month. So what has been coming across your radar and lighting up your tape in the world of energy, sir? And what trades are you mining as a result?
Well, I think, again, when we look at it, we want to ask ourselves what's kind of being priced in and what news are we seeing out there, right? So obviously we had a lot of news. We had the administration had a trip to the Middle East, talking to not the least of which is Saudis, bigger parts of OPEC and producers. Also, getting an agreement to increase capacity. There's some questions of how much capacity there really is to increase. But interestingly, came across another story on Reuters that talked about how Saudi Arabia is importing oil from Russia for domestic purposes to free up more capacity to sell abroad. And so then you start to think, okay, maybe there's going to be a little bit more capacity announced at the August 3rd OPEC meeting. Is the market thinking about this, et cetera? And you can go, the CME Group has an OPEC Plus watch tool where you can see what's being priced in terms of expectations for the August meeting. And for the most part, 2/3 probability when I last looked at it, that it was really going to be kind of a non-event, and the capacity increases that were already announced were the expectation. But I think when you looked at the tails, and a lot of times the interesting trades are in the tails, right? And said, okay, if there's that, still means that there's a 1/3 probability of something else happening, of the 1/3 probability of the market being surprised. And where would the market be more surprised? And so you can look at those probabilities as coming out of the options market. And the market would be more surprised if there was actually more capacity announced or more capacity put forth at the OPEC meeting that had already been announced. And so I think when I start to look at that, there's a very low probability in the options market of that happening. You say, okay, well, you say we've gotten some commitments for capacity increases. In some ways, the Saudis might be freeing up some capacity for foreign consumption. Could this be announced? Is it being priced in? It's not being priced in. And so then you start to look at the charts and the price action in the markets and what's going on. And whether you look at the short-term charts or long-term charts, a little bit of a difference of opinion. And so the market would be surprised, and there's some people, depending on their time horizon, that would probably have to react accordingly. And that's why I started to think about the idea of in the Excell with options I do for CME Group, of looking to find a way to put on either puts or put spreads to reflect this sort of setup, I think, in the trade and the news that we might be able to expect.
You mentioned that Excell with options kind of report that you do for CME. How often do you put those out?
Those come out biweekly.
There you go, listeners. So if you want more trade ideas from Rich, you can check them out over there at cmegroup.com. It's just Excell, Excell, with options. And so, put spreads on crude heading into the OPEC announcement. It's not the craziest trade, which is always fun. Sometimes, the meat and potatoes stuff has the best chance of actually working out of that. I know I noticed you looked at both the standard and the micro contracts. Do you have a preference when it comes to these types of trades? And have you been dabbling in a lot of the micros? I know a lot of our listeners are starting to get intrigued by these across a broad spectrum of complexes, the equities, crypto, energy. Have you been dabbling a lot in the micros lately, Rich?
I have been dabbling more and more in the micros because they're just a much more cost-efficient product. I mean, depending on the size of your, of your trading assets, of your fund, et cetera, they can give you, a lot more cost efficiency and a lot more leverage to execute the same ideas that you would in the standard contract. So I definitely would encourage people to take a look at them, because what we're seeing is that there is quite a bit of adoption, and we're starting to see a lot more volume come into these products. And so I know when you talk about the light side and the dark side, you want to look at where the volume is, because you don't want to put yourself into a trade where there's no volume. But the micros actually have enough volume for, I think, most people to really be able to express what they want.
And what is the structure of these put spreads? Are we talking just straight weekly, let's say at the money to 5% out of the money put spread? How did you structure these put spreads going into the OPEC announcement?
Yeah, so it's interesting. I look at a few things, and I know always people will be like, well, why do you want to use a put spread instead of just using a put, and kind of keep the open-endedness of your potential gains in place. But what you find is that for the same premium you spend, you can actually find a put spread that then kicks in a lot sooner, right? So ultimately, the worst feeling for any options trader is you get the direction right, but you pick the strike and it doesn't quite get there, or goes right to strike and stops, right? And so having that where the profitability kicks in a little faster, I think that's the benefit of using the put spread versus the outright puts. And so I can I'll always looking to find at least 2-to-1 if I can find it, ideas to gauge against or protect against when you might get something wrong. And so, that's where I was able to find essentially an at the money 95%-ish put spread to put on to reflect that. And I think to look at the equivalent amount of premium in and outright, you would have to go much further out of the money to get the kind of the same bang for your buck, if you will.
I like it. Interesting stuff. You can check out, again, the full write-up for yourselves, listeners, over there at cmegroup.com. Let's dive into a little bit of WTI. I can mention RBOB and Nat Gas were lighting it up. Not WTI this week, but RBOB, unfortunately, not a big volume mover and shaker, so we'll head out into our WTI. I know a lot more of you watch this product. 96 and about a third coming into showtime. In terms of action, actually a pretty decent week, which, again, not entirely surprising. We do have OPEC coming up not too far down the road. 509,000 contracts on the tape. That's a pretty robust week for WTI. And of that, looks like over half, actually, 55, almost 56% coming in the D's contract. So a little bit farther out. Not like an equity where everything's going away tomorrow. That's kind of refreshing. What is the vol out here right now in WTI, listeners? 47.5. That's off about 3.4 points on the week. But still, as you can see, pretty frothy compared to, pick your poison. That's more volatile than a lot of the complexes we're going to talk about on the show today. Skew-wise, the puts were where the bid was last week. That remains the case this week. 6.3% bid last week. 6.9% bid this week. So folks have some interest/concern in the downside all the way out to December in WTI. Calls 3% cheap last week, 2.1% cheap this week. So still cheap, but a little bit less cheap, shall we say, than they were this time last week. And in terms of the big dog out here, once again, we're going out to some of these interesting strikes again with this 1 point wide. 1 point wide, couple of 1 point wide verticals, actually. Listeners, someone is up to some interesting stuff up here on the upside here in December. That's why we're seeing so much action here from an overall volume perspective. We saw this week in the DEES 135s did 85,000 contracts. 134s also did 84,000 contracts. Again, they were lockstep all week long, 15,000 each on Tuesday, 35,000 each on Wednesday, 35,000 each again today. Not to be outdone, we also saw about 39,000 of the 120s and 32,000 of the 119. So not quite one-to-one there, but they were one-to-one on Tuesday, or close to it, 33,000 of the 120s and 30,000 of the 119. So once again, we're seeing this a very interesting, very tight upside paper here in WTI. This has kind of been the order of the day for a couple of weeks now. It seems like, though, listeners, that they were bailing on what they had been putting on in recent weeks, because looking at the paper on Tuesday and Wednesday on the 135s and again on the 134s and also on the 120s and 119s, on Tuesday it was all closing. So looks like whoever was putting on this very tight, call it a strip, call it what you will, is taking it off this week. So maybe they're deciding discretion, the better part of valor. Maybe they didn't quite get the move they were hoping for. Either way, it looks like they were taking a lot of that off this week, which accounts for the fairly heavy paper. A lot of contracts to put it on, a lot of contracts to take it off. And some of our other shows, we tend to call this kind of stuff the love your broker paper. We really just want to put up a lot of contracts to not do a heck of a lot. That sometimes can be the case, and it looks like we had maybe the whiff of that out here in WTI this week. Since it was lighting up the tape quite a bit, I want to drop into nat gas as well this week. Nat gas, of course, a big mover again this week. Number 4 to the light side, up 7.9%. Rich, when you're not hanging out there in good old WTI, have you been paying attention to nat gas? I mean, it's kind of hard to avoid it, right? It moves so much, or is it maybe that it's moving so much that you want to stay away from it?
Yeah, sometimes I think the best trades are when you sit on your hands and do nothing. But nat gas, obviously, there's tons of news in the product, right? You've with everything that's going on, with obviously the weather that we've seen here in the U.S. and the demand for air conditioning, et cetera. But I mean, obviously, the continuing price of electricity and nat gas in Europe is has a lot of people thinking of what does that mean for the U.S.? What does that mean for LNG exports, et cetera? So, I mean, there's just so many different moving parts. Nord Stream 1, does it come on? Does it not come on, et cetera? And that saga that goes back and forth, that's one where I just feel like right now I don't have a lot of edge in kind of calling the direction for it, but I can totally understand why there's so much volatility and so many contracts being traded.
Yeah, we've had a lot of guests come on the show over the last few months who are very active in nat gas, and they've all said pretty much the same thing you just said, that if you're not already pretty well versed in nat gas, these are markets you probably want to stay clear of. It's very easy to get run over. And it seems like we have a pretty active week, all things considered, out here in nat gas this week. Not quite a Rock'em Sock'em Robots week, about 319,000 contracts on the tape. Again, we usually see north of 400,000 by this point in the week, so actually kind of a little bit light. By the way, coming into showtime, nat gas at about 813, so well north of the 6 handle it was at not too long ago. 22% of that 319,000 contracts coming in that front September contract has about almost 30 days to go, so we can hang out there. The vol right now in nat gas still pretty frothy, almost an 89, 88 and 3/4, off about 4 points this week, so obviously much more volatile than most of the products we're going to talk about on the show today. Even more volatile than what we were just talking about out there in WTI, almost 2x. In terms of skew, we've got the puts last week, 2.9% cheap. This week, 4.8% cheap. The calls, a 7.5% bid, so the interest/concern remains to the upside for obvious reasons. This week, 6.9% bid, so a little bit less aggressive to the upside, but still pretty hefty bid to the calls. And in terms of the action, what was leading the dance out here this week, listeners? Well, there's a lot of paper kind of across the board, but it looks like it was the 10, once again, we're back to the 10 strike, listeners. The 10 calls in September doing 7,385 contracts. The big day actually today, 2,100 on the tape today, 2,035 on Tuesday. Let's see, and then 1,600 each Monday and Wednesday. Kind of back and forth, opening to closing all week. So folks piling into the 10s, then getting the heck out of Dodge. A lot of that kind of action out here this week. Also saw right behind it the 12 calls. So if 10, not quite optimistic enough for you listeners, we got the 12 calls doing 7,300 contracts this week. So actually only 13 contracts behind the 10s this week. So a lot of action. Big day for them was actually today as well. 2,789 going up today, 2,400 yesterday, 1,700 on Monday, only about 500 on Wednesday. And again, back and forth, opening to closing on this one as well. So the 10s and the 12s here in September, leading the dance this week. Listen, let's go a little farther out and see if we can find any other weird or aberrant paper. There's always something lurking here in nat gas. 9 calls, pretty active here in February of next year, doing 4,500 contracts. That's kind of interesting. The 10s are active again into next year. We've actually this is 2024. We've got July of 2024. 10s were trading. They were trading in June as well. So, wow, a lot of paper going up on the 10 strike, kind of across the board. And that's not terrifying enough for you. Let's go out to April of 2025, listeners. 10 calls trading there as well. So it's like the 10 calls, and this the 10 strike in general, the strike du jour here in nat gas. But now it's time for us to roll out of energy and get into the complex that's kind of dominating our tape this week. It's all about the ag, so let's hang out there next.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, everybody, welcome to the wonderful world of ags. You guys know where to find that in that drop down. Pop out of energy, go all the way up to the top of the asset class. It is an alpha order after all. And then let's get out to the ags. Let's start in grains and oil seeds, and we'll see where our journey goes from there. But Mr. Rich, when you're not looking at energy, I know you've been pretty busy this week here looking at a bunch of interesting option strategies in the ag market, sir. Which markets are you looking at, and what trades are lighting up your tape this week, sir?
Yeah, well, I mean, when the last special ag report I did on the Excell with ag options, it's a new feature we had this month, was looking at some bullish ideas in live cattle and in the short-dated new crop corn. So generally, I think when you look at the price action across the ags, whether grains or livestock, you obviously has been some pretty bearish price action for most of the end of the second quarter. Now, as you point out, on the light side, a lot of that's turning around, certainly in the last week or so. But what we were looking at when that report came out a couple of weeks ago was the idea that there's a lot of potential longer term holders in futures have been kind of getting flushed out that might have been there because they were looking at it as more as an inflation hedge. And as inflation might be peaking and the price action is lower, are some of these what I would call ag tourists, are they getting squeezed out of their positions? And does that create an opportunity then to look at the bullish side of the trade for people who are looking at that, a little bit longer term and understand the positive seasonality for both live cattle and short-dated new crop corn?
And before you recoil in horror at the notion of trading options on live cattle, listeners, that's another one that's gotten a lot more active in recent years. 26,000 contracts on the tape in live cattle right now, Rich. So the days of doing a few hundred, maybe 1,000 contracts a day in the livestock, those are kind of behind us, Rich.
They are. I think you're just seeing them more and more, whether it be individuals, RIAs, funds, et cetera, have more tools at their disposal to analyze and implement a lot of option trades. And people are starting to look more and more at across a number of different products and saying, hey, you know what, there's opportunities here. And I can use the knowledge I've gained in trading options on other products and put them to work here. And there's actually quite a bit of correlation across the entire ag landscape, certainly this year and kind of even going back the last 18 months or so. A lot more correlation than normal.
All right, Rich, so it looks like in your report you have a bullish three-way in the live cattle and a short-dated new crop 1x2 call spread. So a lot to sink our teeth into. Break them down for our listeners, sir.
Let's go with live cattle first. Why not, right?
All right, bullish three-way in the live cattle. I know our listeners will be intrigued. What were you up to out there?
So again, I'm looking at a few different things. Primarily looking at, as I mentioned, the correlation and saying, is there an opportunity here as all of the grains and livestock futures have been coming lower, and then looking at what's been trading. Right, live cattle futures have increased in price the last couple of years. Spread trading has been a majority of the options volume for the last 3 months. With a lot of verticals and a lot of three-ways being really, really popular strategies in that product. You look at the setup and you look at where the volatility was. The volatility, if use the CME's CVOL, looked a little bit on the elevated side. And you look at the skew levels as well and say that there's a little bit more skew that I might want to try to sell out of the put side of the equation. And so what the bullish three-way was selling a put spread and buying a call, using the premium to buy a call, and doing it in a zero cost way, because this was a way for me to set up this bullish idea on a zero cost way to kind of give a lot of potential upside. I think most people either can't or don't like to just sell that risk reversal, or sell the puts naked to buy the calls. And so I think selling the put spread is a way to kind of protect and insulate the risks you have on the downside, and then using the premium to buy a little bit further out of the money upside still puts you into a bullish trade. And it really, again, as I said, a lot of the option volumes that's going through in live cattle, as you mentioned before, the 26,000 contracts is going through in these three-way type of trades.
I like it. I happened to pull up live cattle while you were talking here, Rich. And if you're wondering, listeners, live cattle 136.20 is where it's hanging out coming into showtime. Again, almost 27,000 contracts on the tape, so a pretty robust week, all things considered. 37.5% of that going up in the contract that has about 8 days to go, so that's a little bit close to home for us. Let's go out here to the October contract that has about 71 days to go. That did 28% of the paper out here. By the way, if you're wondering what is the vol in live cattle, and that front contract is about 10 3/4 off about $1.50. If we go out to the October contracts, at about 13 off about a third point this week. So not the most volatile product on the planet, which maybe should give you a little bit of consolation if you're concerned, if you're spooked about diving into the livestock waters, about getting run over. At 13 vol, not the scariest water to dip your toes into. And in terms of skew, the puts last week, 10.5% bid, so a lot of interest in the puts. This week, 6.7%. The calls last week, 1.4% bid. This week, 5% cheap. So calls coming in, puts very bid. So intriguing little swing out here in the options on the old live cattle. In terms of the big dog this week, it was the 137 calls going out in about 7 days. Those are actually almost 8 days. They did about 2,500 contracts this week. The big day today, 1,300 today, 1,000 yesterday, and not so much throughout the rest of the week. So that's kind of the big dog out there. But I know, Mr. Rich, you also have a short-dated newt crop 1x2 call spread up your sleeve. What were you up to out there, sir?
Well, I looked at it from a couple different angles. So I'm going to, Mark, I'd like to only do, frankly, 1x2 call spreads when I already have an underlying long position, and I like to use it as leverage, right? So you get the call spread and essentially an embedded buy right then too. And because of course, it's hard enough for us to get the direction right sometimes. You don't want to get the direction right and then get it too right and have it blow through the upside of your 1x2 call spread where the break evens are. And so that's why I usually like to do this. And I did recommend doing this if you had an existing long position, again, relying on this positive seasonality as we go into the end of the year. And that's one way to think about it. But the other thing that I was looking at in the corn market is there's a lot of congestion to the upside. And so oftentimes when you see this congestion, or where you see a lot of that activity, that's going to be a bit of a magnet. But it's also, to me, in my experience, seeing that when you've got a lot of that open interest in a certain area, the futures are going to be attracted to it, but then you're going to sit at that level and churn for a while. And so that's one where I suggested, even on a directional basis, one might, knowing all the risks that is, one might want to consider a 1x2 for directional reasons, because as you kind of got to that upside strike that you would be short two of before you even got to your break even, you'd be running into this congestion, and the futures should be slowing down as those strikes serve as a magnet until people start to unwind some of that open interest. And so I looked at it really from a couple different ways. I'll tell you, my preference is always to use the 1x2s for leverage on top of existing underlying positions. But in this particular case, I thought, given the way it was set up, one could look at it from a directional standpoint as well.
Interesting. So what we might consider a more traditional repair type strategy where you have the underlying and you're buying one, let's say maybe near at the money type call, and then selling two farther out of the money calls against it. You get a nice pop, and you get a nice little pop in your position as well. Interesting stuff. Since you're talking corn, I'll swing out there really quickly as well. Of course, staying in the ags, listeners, drop into the corn and oil seeds and go all the way to the top of the list. That is corn. Corn coming into showtime, 614 3/4. Nice 50 handles, or nearly 9%. So a strong start to the week here. Of course, not enough to make it onto our movers and shakers in a week where everything is pretty much rocking and rolling. But all the ags having an interesting week out here this week. How much paper on the tape in corn this week? 440,000 contracts. So nothing to sneeze at out here in corn. Of that, 39% coming in the Dees contract. Has about 120 days to go. So we're going to hang out there. If you are wondering, the corn vol, 28.5 off 2.5 points. So you're talking even more frothy still than most of your equities out there right now. So intriguing stuff afoot. In terms of skew, last week, no one wanted the puts. They were 1.7% cheap. This week, people want them even less, 10.5% cheap. So folks are coming for these puts. The calls are unchanged on the week, 8.7% bid last week, and that remains the case this week. In terms of action, the big dog out here by a country mile, listeners, 700 calls in December, 22,555 of these bad boys. Again, the big day is today. Today's a big day for all these complexes. 13,667 going up today, 4,800 on Tuesday, 1,800 on Monday, and 2,000 on Wednesday. It looks like opening all week long, so folks piling into that 700 strike. We're hanging out at about a 620, so it makes sense. We're kind of getting closer to that 700. Makes some sense so that folks will be opening on that strike. And then right behind it, we have kind of a tie. Looks like the 800 calls in December, just barely taking it with nearly 17,000 contracts. Once again, the big day today, 7,800, 4,000 on Wednesday, 2,500 on Tuesday. We also have a lot of action here in the 650s in September. These have about 30 days to go. 16,500 of those bad boys going up. The big day actually Tuesday for those. Nearly 7,000 on Tuesday. Looks like slightly closing. And then we have 3,500 on Wednesday, 3,300 on Monday, and then 2,600 going up today. A lot of action in corn, but I can't move out of the ags yet, listeners. It's a heavy ags week because, as we mentioned at the top of the show, dominating our movers and shakers this week is the entire beans complex, the meal, the oil, and of course the beans themselves. So we'd be remiss if we did not take a quick look at soybeans this week as well. Soybeans coming into showtime, 1456.75, up 129.25 handles, or 9.75% just since Monday's session. So a big pop out here across the whole ag complex. Good for a fair amount of paper as well. 271,000 contracts going up in the beans this week. Of that, nearly 41% going up out here in the November contract. The vol, 28.5, so very similar to what we're talking about out there in corn. And again, also more elevated than we're seeing in a lot of your equities right now, outside of maybe small caps, which we'll get to in a little bit. In terms of skew, last week 1.3% cheap. This week 4.2% cheap, so that put wing coming in. The calls 3.6% bid. Last week 5.6% bid. This week, kind of hard to argue with that. We have seen a pretty aggressive pop in the beans this week. And in terms of the action out here this week, 1,500 calls, which again, we're at a 1439 in that October future list, November future. So we're talking the 1,500 calls getting the lion's share of the attention this week. The big day, once again today, 4,700 going up today, 3,000 each on Tuesday and Wednesday, and 1,500 on Monday. Total of about 12,300 on the week. So pretty active week. Looks like opening most of the days as well. So a lot of opening paper on the 1,500s. Again, we're getting closer to that strike, so it makes some sense. Folks might want to pile in out there. It also makes sense given this topsy-turvy crazy week with the Fed and everything else, listeners, that folks want to talk about some equities. So let's head out there next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Welcome to the wonderful world of equities. You know where to go, listeners. Go into that drop down, pop out of ags. Then we're going to scroll down 3 more slots to equity indexes, and then pop into the Russell 2000 on the product side, and we'll sink our teeth in there. Before we get into that, though, let's set the table from a volatility perspective. And like we said, all those ag complexes hanging out close to a 28. The only equity you're going to see, well, actually there's 2, I take that back, that are kind of hanging out in similar land is RVX. So that's the VIX of the Russell 2000. So that's your small cap vol. 2685 when we kicked off the show. Still down on the week, 170, but still looking pretty frothy. VIX itself, of course, the vol of the S&P 500 coming down to about 2230 when we kicked off the show, down about 1.1 points. VVIX, so the vol of vol, this is really interesting, listeners, 79.90, so shy of the 80 handle, down 4.5 points on the week, and starting to get within spitting distance of that 75 level, that level where in the pre-pandemic days, which seem like a lifetime ago now, we would start saying to ourselves, vol is getting pretty low. It's probably going to pop soon. And now in these crazy post-pandemic markets, who knows what is in store for us. But a very interesting level to watch, a level we have not been at in quite some time, listeners, since before the pandemic. So intriguing stuff. Vol Q 2640. So another one that's close to not quite at most of the ags are at about a 28 vol, but pretty close. 26, close to 26 and a half, down about 1.4 points. Vol Q, of course, the at the money vol of the NASDAQ 100. That puts that VIX to RVX, so that large cap to small cap vol spread, 4.5 points. That's about 0.6 of a point tighter than it was last week. And the VIX to Vol Q, so S&P to NASDAQ vol spread at about a 4.10. That's about 1/4 of a point tighter than last show. Mr. Rich, before I dive into what's going on in the world of small caps, I know you research a lot of different complexes. Have you been paying attention to equities and anything lighting up your tape out there this week, sir?
It's really hard to not pay attention to equities, isn't it? Even if you wanted to, you probably couldn't get away from it if everything the media covers it. But yeah, I absolutely looking at equities and more importantly, looking at the top line index level, and this goes back to even like right after the holidays, was noticing that even as we were getting high CPI prints, et cetera, and high PPI prints, and knowing the market's worried about inflation, we're seeing positive price action that was not intuitive to a lot of people, suggesting that maybe the worst news is priced in. And we've seen that across a lot of the different surveys that you could look at, that there was just a great deal of negativity. And now we're starting to see that as we're going through earnings season, because July is obviously a huge, huge month for earnings. And we're seeing that across the earnings, they're coming in not great in absolute terms, but better than worst feared, better than expected in some cases, and the stocks are responding accordingly, right? That was started with a lot of the bank stocks where things came in better than expected. You saw positive price action in financials, which started to move the markets higher, and then we've seen it with the big cap tech, where again we know the news is going to be bad. It's not as good as it was, but is it better? Is it better than what was the worst feared coming into the earnings season? And the stocks are responding accordingly. So I think, to me, you want to pay attention to two things. You have to respect price action, right? You have to respect the technicals, and that's all been pretty positive in the equity space for sure. But you also want to appreciate that there are weakening fundamentals out there, and so maybe what we're seeing is much more of a tactical or a bear market rally because fundamentals are weakening. How much so? That we're as data dependent as Jay Powell is after what he's talked about yesterday. But I think you have to really kind of respect the fact that when stocks go up on bad news, that's giving you a lot of information.
It is indeed. We were arguing on our last show, Rich. Does the emperor have no clothes? Is it one of those where just you feel like you're the only sane person in the room sometimes, and everyone's buying on weakness? But intriguing stuff nonetheless. Let's get on out to the land of small caps, see what's lighting it up out here this week, listeners. Russell 2000, not quite at that 2000 level again, but getting a lot frothier this week. 1869.10 when we kicked off the show, up 60, almost 61 handles, or about 3.4% just from Monday's session. Of course, if you dial it back, it gets even more lofty. In terms of how much action on the tape this week, closing on 20,000 contracts. So a pretty active week out here, all things considered, for all things small caps. What is the vol out here? By the way, most of that action, once again, going up in the contract, going away in one day. That contract's at a 30.5 vol. We won't be hanging out there, though. Listen, let's go a little bit farther out. Let's go to the week 3 August contract. That has about 23 days to go. That did 24% of the paper this week. The vol out there, 24.75, down about a point. And in terms of skew, the puts last week, 10.3% bid. This week, 11.9% bid. And the calls last week, 7.7% cheap. This week, 9.9% cheap. And in terms of action out here, we actually have a lot of love. Looks like, well, it's kind of a bit of a tie almost. 1880 calls, doing well over 1,000 contracts this week, going out tomorrow. Those are pretty active. Looks like an 1880-1900 vertical going up today, about 1,000 by 800. So not quite one to one, but pretty close to it. Obviously, we don't have the OI numbers. That looks like that all went up today, which is kind of also, it's like a bit of an 1870, 1970, 1920, 1 by 2 by, the ratios are all off, listeners. 180 by 245 by 100 contracts going up. So a bit of a funky, not quite a fly there as well. So it looks like a lot of paper going up to the upside here. And all of this going out tomorrow. So Gotta love an equity. Let's go a little bit farther out. Also, the 1900 is pretty active in the week 3 August contract. Looks like, again, a pretty tight vertical. It's the 1960-1940 going up 763 times on the 60s and 749 times on the 40s. So pretty much 1-to-1, 1,500 contracts going up pretty much in total on that vertical. So tight verticals, very tight verticals, and 20 points wide, and the other one going out to more. Why are you putting up a 1880, 1900 with 1 day to go? That's an interesting one as well. So a lot of interesting paper. Again, you guys are asking us a lot about small caps. What about the small delta calls? And seems like we're getting some action in that arena out here today. Mr. Rich, we got a little bit of time left in the show here. We covered a lot of complexes already, but you are our guest. I will let you pick our final complex. Where should we head out to next, sir?
We could probably head out to the rates complex next. That's where a lot of the action's been, right?
All right, let's head out to the rates next.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody, welcome to the rates complex. Of course, it is a Fed week, so you probably could guess that we were going to head out to the rates complex. Go into that drop-down, listeners, pop out of the equity indexes, and then we're going to go all the way down 2 more slots to interest rates. Then we're going to hang out in U.S. rates, and then it's kind of a pick your poison where we go from there. I know, Mr. Rich, you've been looking at a lot of different parts of the yield curve for your Excell with options reports, including dropping in on the newest edition, the SOFR options. What's been lighting up your tape out there in the rates this week, sir?
Well, I think, you have to get used to the SOFR options. I know that's something new and different for a lot of people, but that's we're getting rid of Eurodollars, and so SOFR's where the action is going to be from now on. So I think you want to put that on your radar and pay attention to it. But the report that we put out on SOFR options was positing the possibility of a Fed pivot. We wrote that a couple of weeks ago. It came out, I think, July 12th, and we're thinking about the Fed pivot, which obviously now everyone's talking about, whether or not there was a pivot yesterday or whether there will be a pivot. What I was looking at in that report was this idea that we have the Jackson Hole Economic Symposium coming up at the end of August. And if we looked at what the market was expecting for the rates being priced in, not just in the July meeting, but the September meeting, and then into 2023, where the market is pricing in rate cuts for the Fed as we get into 2023. However, if you looked at the Fed dot plots were still suggesting that we were going to see rate hikes in 2023. And so there's a disconnect between the Fed and the markets, not so much this year, but in the next year. And so my thought was, at some point, the Fed's going to have to do something to either tell the market they're wrong or start to pivot towards the market. And I thought that the Jackson Hole Economic Symposium, where all the global central bankers get together, has historically been a place where the bigger ideas have been talked about, because the global central bankers get together, tell each other what's been going on in the world. A lot of academic research papers get published, and it's oftentimes a place where we would start to see maybe a pivot. And my thought was that if the Fed officials start to get together with their peers, of course they're talking to them throughout the year, but and you're seeing that, because what you're seeing is the aggressive Fed relative to other central banks this year has caused a big move in the dollar, right? We certainly see it in Europe, as we talked about last time I was on here, Europe or the UK, but it's really causing a lot of pain and a lot of stress in emerging markets, countries where they issue debt in dollars, and so there's been a little bit of a dollar wrecking ball going around, causing some problems around the world. And then you're looking at the possibility that before September, the Fed's going to get a couple more CPI prints, a couple more jobs market prints, and so could we see jobs coming down? Could we see CPI coming down? And is it time then for the Fed, being data dependent, to start to think about slowing things down? And is August the time when they might mention that? And so that's what we were looking at. And ironically, when we looked at the SOFR, not the futures market, but the implied volatility market, the implied volatility for September was below that of everything around it. So the market had elevated volatility for the end of this year into next year. because that's when the market was starting to see rate cuts come in, but it had even higher volatility for the July meeting than it did for the September meeting. And so we looked at putting on, I love those time spreads, but a call time spread diagonal where we sold some of the stuff in July where we thought a lot of the news was already priced in, and bought some in September where we could potentially see a Fed pivot in August and see a lot more potential upside on a relative basis in the September contract. So there was a lot going on in there, Mark, but that's generally what we're looking at. Was we were talking about the Fed pivot a couple weeks ago, and now that's all the market wants to talk about, it seems.
Yeah, SOFR, an interesting one. We haven't really talked about it much on the show. In fact, last week we were chatting with our guest Todd Colvin, and we were both kind of surprised at how light the volume was in Eurodollar options. And of course, the reason for that, listeners, is because SOFR is starting to siphon off a lot of that paper. In fact, right now, if you go out, listeners, into that drop down for the rates, you're going to want to hang out in the 3-month SOFR. That's where most of the action is. And a fair amount of action this week for a newer product, 1.65 million contracts on the tape this week. So clearly nothing to sneeze at. These are definitely Eurodollar type numbers. So if you're wondering where all that Eurodollar paper was going, we were talking about last week, it is going here into the 3-month SOFR contract. And in terms of that 1.65 million contracts, about 25% going up in this SEP contract that has about 50 days to go out here. What is the vol out here? You might be wondering, 64.5. Eurodollars and now SOFR, kind of the place you want to go on the rates complex if you want to get a little dose of volatility. You start going out to the 10-year or even the 30-year, not really synonymous with vol. But SOFR and, of course, Eurodollars, they'll give you a little bit of vol. This week it's 64.5, off 10.2 points. So a lot of vol action out here this week. Skew-wise, also get some skew action out here as well. So if you're coming from the equities or some of the more action-packed complexes, you think maybe rates won't do it for you. Some of these contracts can give you a little bit of a surprise. 5.4% cheap were the puts last week in the SEP contract here in the 3-month SOFR. This week, they're pretty much even with the at-the-money, so they've been bid right back up. The calls last week, 6.1% bid. This week, 16.8%, so a huge pop to the calls out here this week. And in terms of the hot contract out here in the sea of paper, again, 1.6 plus million contracts going up out here this week. It seems like the big dog was actually, looks like the 97 and an eighth in the D's contract, doing 62, almost 63,000 contracts. I'm just scrolling, listening to see if I see anything bigger than that. No, I do not. 97 and an eighth. By the way, how refreshing is it to have eighths and teenies again? It's the old school SPX and equity option guy that I am. That's how I cut my teeth in the business. So it is kind of refreshing, if antiquated, to be throwing around the eighths and the teenies again. 97 and an eighth was where the action was this week. 62, almost 63,000 contracts. 0 on Monday, 5,200 on Tuesday, 37,500 on Wednesday. So it went literally from 0 to 37,500 in 2 sessions, and then back to 20,000 exactly today. Not even 20,001, 20,000 exactly. I love the numbers these kind of contracts can put up. So all opening paper on this 97th and then 8th contract. So serious paper out here. Not to be outdone. Well, it was outdone, but pretty darn close. We also saw the 97 and a quarter calls going up in this SEP contract, doing 57,600 contracts. The big day for them was Monday, 37,000. Again, 0 on Tuesday, and then 20,000 exactly on Wednesday. So this paper does seem to line up numbers-wise to what we were just talking about there in the D's contract as well. 20,000 lots, 37,000 lots. Seems very similar, but intriguing stuff nonetheless. Man, there's a lot to unpack. I have a feeling, Rich, we're going to be talking about SOFR a lot more on the show going forward. By the way, if you're confused what that is, listeners, that is the secured overnight financing rate. You're familiar with LIBOR, obviously the London Interbank Offered Rate. Now we've got SOFR to add to your lexicon, secured overnight financing rate. But we are coming up against it, listeners. Let's get really quickly into your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to the Futures Options Feedback. Let's go quickly out to the live. You folks know, listeners, if you're in the live, then we like to bump your questions up to the top of the list. TheOptionsInsider.com/pro is the place to go to join that fun party. Also gives you live access to all the shows we do on the network here, so it's pretty fun stuff. Rich, Options Queen, has a question for you. She wants to know a pretty straightforward question. You know, you've talked about options trades in a whole bunch of different complexes. We were talking about livestock, we're talking rates, we were talking ags, all over the place. Options Queen wants to know, how does Rich choose his options trades?
That's a really good idea. Really good question. So how do I look at it? I look at where I think I come at it from a few different angles. I look at fundamentals, what I call behavioral, which is really the supply and demand, and then the catalyst portion. So I want to look in where I have good ideas on the fundamentals and where I have a pretty clear understanding of what's driving it. I want to see where there's a mismatch in the supply and demand of where people aren't necessarily seeing the world the way I'm seeing the world, because I think that's oftentimes where you see the bigger moves. But then importantly, it's that last point. It's the catalyst. What's going to get people to change their mind? And so especially when it comes to options, which are an instant gratification tool, I love using them, but you need to have that catalyst. And so I'm always looking, I'm the calendar on my board of what's going on in the next month and where are the catalysts. And that's usually where my eye is drawn. So, OPEC meeting next week, and we're looking at OPEC. The Fed meeting this week, a couple of weeks ago, we're looking at SOFR options. So I'm always looking at where's the catalyst that the most people are paying attention to.
So it's not like you're sitting there looking at the CVOL report, for example, and saying, okay, this one looks hot. I'm gonna sink my teeth into that. You're looking at a complex that already has something going on, and then you start analyzing out there.
That's exactly right. I mean, one of the first places I will look when I want to dig in is the CVOL to see, again, how has this been trading, what's being priced in. But I'm looking for the catalyst, and then I'm going to start my analysis and say, okay, where's the opportunity? Is it going to be from the long side of volatility, short side of volatility? Directionally, what you just generally kind of get a sense of how I might want to structure something.
All right. Before we get out of here, let's look at our question of the week. By the way, our question of the week last week, listeners, we said, we've seen a nice pop in equities and crypto over the past week. Are you buying back in at these levels, or is there still more blood to come? I gave you 4 choices. I'm buying equities here, I'm buying crypto here, I'm buying both here, or there's more blood coming. And you folks are very bloody minded right now. 62.3% of you said there's more blood to come, followed by a distant number 2. 16.4% said you're buying equities here. It looks like that one worked out all right, at least in the near term. 13.1% said you're buying both crypto and equities there. And buying crypto was a distant 4th, 8.2%. So I guess you're not that bullish on crypto yet. Our question of the week this week, kind of along those same lines in terms of levels. We said the Fed is back this week, sending traders into a tizzy about interest rates. If you had to buy an S&P at-the-money call or put, at the time you posted this at the beginning of the week, we were at right around a 39.70. Obviously, we're north of 4,000 now. We said if you had to buy an at-the-money call or put in the S&P expiring at the end of the week, which way would you go? Would you buy the put, so you're going to fade the rally? Would you buy the call, so you were full on in rally mode? Would you buy a straddle because you're greedy? Hit us up, let us know. Mr. Rich, what were your thoughts on this? And then more importantly, what do you think our audience is voting for? They're buying that put to fade the rally. They're buying the call because they think this rally is going to continue. Maybe they're buying a straddle because they're very greedy. They want movement. They don't care where it is. What do you think our audience is up to, Rich?
Well, last week when I was talking with a lot of people and I was writing my weekly blog, the sense of this negative sentiment in the market was very, very high. That's one of the reasons why I was particularly bullish coming into this week, even the last couple of weeks. And so I still think that there's a lot of bullishness or bearishness, I should say, because even though the price action has moved higher, people don't understand why it's moving higher. They think this is something to fade because it doesn't make any sense because the fundamentals are weakening. So I'm going to guess your listeners wanted to fade this rally.
Let's see, Mr. Rich. They are a bloody-minded group, as we have discovered earlier. All right, so listeners, you guys can find this for yourselves, of course, at Options on Twitter is the place to go for the results. And right now, they are still a bloody-minded bunch. 59.3% saying they want to fade this rally. 35.2% saying they want to buy the call, so they're in the full-on rally mode. And 5.6% of you said you want to load up on that straddle. You're feeling greedy. You don't care where we go. This had to move far away from the 39.70 strike. All right, and that's going to do it for this episode of This Week in Futures Options. I want to thank our guest, Mr. Rich, who's cranking away on that Excell with options report. I know, Rich, our listeners are going to be intrigued by all your trades. They're going to want to check out more data. So if they want to learn more about what you're up to, where should they go? What should they do?
Well, they can find me on Twitter at Excell Richard is my Twitter handle. I'm probably more busy, active on LinkedIn. I put out something every day on LinkedIn, so certainly follow me or connect with me on LinkedIn. But I also put out a much longer form weekly piece that follows my entire process. It's called Stay Vigilant. It's Stay Vigilant blog. It's stayvigilant.substack.com. And that's where you can find a lot more of a long-form piece where I look at all risky markets and around the world.
There you go, stayvigilant.substack.com. You can always head on over to cmegroup.com as well. Check out his Excell, Excell, with options reports. He's got a bunch of them up there. So if you're looking for some interesting idea generation across all the different complexes going up over there at CME, that's a good place to go. Of course, while you're over there at CME Group, you know where to go. cmegroup.com/TWIFO, TWIFO is the place to go. If you're seeing some interesting data from maybe some trade ideas and some of Rich's reports, you want to look at the numbers for yourselves, go into that TWIFO report, pull up whichever complex floats your boat, and you can begin your journey to the dark side. Then, of course, as always, you know where to go to learn more about all things small caps. Listeners, FTSE Russell, FTSE Russell.com is the place to go to begin that journey as well. We just had recon in the rearview mirror. How did that impact the market? What interesting trends and developments did we see coming out of that? There always are quite a few. We had a great sit down with Catherine Yamamoto up there not too long ago, breaking down all that good stuff and a whole bunch more. You can see that data for yourselves over there. FTSERussell.com is the place to go. Also give them a follow on Twitter while you're at it, at FTSE Russell, FTSE Russell, all one word. That's going to do it for us today on the network, listeners. But don't worry, if you need more content in your lives, we're coming at you tomorrow with a trifecta of quality goodness. First off, we have Volatility Views live noon Central, 1 p.m. Eastern, to break down the insane world that is volatility right now. A lot to unpack there. Then for all you folks in the pro, we have a doubleheader coming at you right after that. We have Options Oddities with myself and the Rock Lobster and the folks from Shift Search. And then after that, we have a pro Q&A with those same said folks. You can ask a whole bunch of questions about finding and utilizing unusual options activity. So a lot of great stuff. If you haven't jumped into the pool yet, theoptionsinsider.com/pro is the place to go. So you can get in, get all the login info so you can join that explosion of great content tomorrow. Then we're back again next week, all the way through to next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.